global financial landscape has entered a period of renewed volatility and recalibration following 11 months under the Trump administration. Policy shifts in the United States, ranging from trade realignments and fiscal expansion to evolving stances on monetary policy, have set ripple effects across global capital markets, influencing exchange rates, risk appetite, and investment flows. As of October 2025, gold hovers near $4,089 as investors seek safety amid lingering trade tensions and policy uncertainty. During the same period, oil prices have declined to around $61.5, pressured by rising supply levels and weaker global demand expectations. While most emerging markets have broadly mirrored US movements, following its policy direction and market sentiment, China stands out as a notable exception, charting a distinct path shaped by weak domestic demand and a slower recovery. Inflation trends have moved in opposite directions across the two economies, with the US showing signs of moderation, while China continues to face subdued price pressures. Policy dynamics reveal contrasting approaches, with the Federal Reserve and the People's Bank of China pursuing different strategies in response to their domestic conditions. As the Federal Reserve begins a cautious easing cycle, while the People's Bank of China maintains an accommodative stance to support growth. In currency markets, the US dollar has weakened against major peers amid expectations of further rate cuts, while the Chinese yuan remains broadly stable under managed exchange rate policies. Global equity markets further illustrate this divergence, as US equities push towards new highs, while China's market continues to struggle for momentum, reflecting two distinct economic narratives unfolding on opposite sides of the world. These contrasting dynamics highlight a widening monetary divergence, with the US navigating a soft landing path and China sustaining a pro-growth monetary approach amid lingering deflationary pressures. This session brings together senior policymakers, investors, and financial experts to unpack the implications of these shifts. It seeks to explore how emerging markets can navigate a more fragmented financial order, how global investors are adjusting their strategies, and what policy tools can strengthen market resilience amid global unpredictability.
Before handing over to Omar Shenety to moderate, I want to give a very special welcome to His Excellency Ahmed Kouchouck, our Egyptian Minister of Finance.
Thank you so much, Dr. Abla. Hello, everybody. I think that's going to be a very different session because it's going to be about money, financial markets, how things are going to be moving, how people will make money or lose money. And definitely we'll try to link lots of economics with financial markets. Definitely happy to be here and to be moderating this session. Before we get started, I would like to thank Dr. Abla for the great work she's been doing. This conference has been a dream. This forum for the second year has been a dream. Last year it was much smaller than this. This year it's became massive, and it's turning into a landmark in the scene, not only in Egypt, but in the region. So thank you so much for that. And I would like to thank Mr. Omar and the whole board for his support to Dr. Abla and to us at ECES team. This session today is going to be about financial markets. Before introducing the panelists, and we have a very high-profile panel today, I would like to highlight that a couple of years ago, we started I started collaborating with the ECES on issuing a monthly report called Financial Market Snapshot, which tries to link what happens on the global economy on a macro level with the financial markets, whether on a global, regional, or local level. And we have been issuing like 20 reports so far, and this session today is a reflection of it. Last year we had His Excellency Mr. Ahmed Kouchouck discussing this report in one of the seminars, and we keep getting lots of people here. Today, while we have this session, we have a very high-profile panel. I would like to introduce Dr. Farouk Soussa. Dr. Farouk Soussa is the head of MENA research at Goldman Sachs. Aside from that, he's very big and famous on his very small and short notes that turn everything all around. I remember his note about Ras al-Hikmah deal, and which was on the phone of every single human being in Egypt who can read English, and he turned it upside down and he kept us. So thank you so much for being here. I would like to introduce Mr. Wael Ziada. He's the managing partner at Zilla Capital. He's my bestie, my buddy, and my thinking pal. And he's one of the few people I can talk with freely without limits in this country, because there are no limits to imagination. So I'm glad he's here after his surgery. I would like to welcome Mr. Karim Sawabini. Mr. Karim is partner and portfolio manager at Moon Capital. In real terms, he is the biggest investor in this market, in equities. If you know his schedule in Egypt, you can know very well what are the companies that will outperform in the stock market in the coming days. I have interrogated him for the last hour trying to know who he is meeting, but he didn't say. So that's a very important guy. We have Mr. Binitie. Mr. is CEO of Resrv Technologies. Mr. is the remittances guy of Africa. If you want to know how remittances go into Africa and how money goes into the system, he is the guy. He knows everything about it. And finally, we have His Excellency Mr. Ahmed Kouchouck, the Egyptian Minister of Finance. But on another term, he is a very well thought of economist, a friend of ECES, and a friend for all of us. He's carrying a very big responsibility on behalf of all of us. Someone has to take this big responsibility, and I'm glad he's doing it on behalf of our generation. So thank you so much for doing that. Let's get straight into the session. 12 months of Mr. Trump since he has been elected, and since the day he has been elected, everything in this world has been turned upside down. Over the last 12 months, we could see unpredictability, uncertainty skyrocketing. You could see it in how volatile the markets are. Every day is very different. The market is driven by tweets, whether on X or on social truth or on whatever. His interviews define what happens from an age where collaboration and integration to a world where there are trade wars. Trade has been weaponized, and as we have seen in previous sessions, trade is a weapon now. Discussions about AI being reaped as fruits all over the world became discussions as who will get the benefits of AI, who will be allowed to import chips from American companies, and who is not. We have seen gold and silver and commodities skyrocketing. Gold is above $4,000 an ounce. Very crazy. We are seeing the dollar, which is the cornerstone of the global financial market, losing value against nearly all currencies all over the world, and the US is happy. And we have this very big problem. We have seen this region over the last year going through the latest about the war and its conclusion, which was a very big humanitarian crisis, but we still are figuring out what to do about that. But on the other hand, we are in Egypt, at least going through a very good time, and we have been talking just before the session that seems everything is in order. Numbers look good, and we are happy to be about that. So where does this take us from here? So, and I would like to start with Mr. who has the brightest smile in Africa. The last year has been chaotic. How do you see this last year, the first year of Mr. Trump in his second presidency, compared to his first presidency? How does this change? How do you see about volatility? How do you see this happening and playing out at an overall level, especially from your interactions?
Thank you very much for being here. It's a brilliant conversation. I think the pre- and post-Trump era is defined largely by three things. I would say that the first one is fragmentation of the markets. So you find that there's regional groups are consolidating value chains, tariffs. I think this everybody experiences. I think the second thing you will find is that the monetary polarization. So again, you find this shift towards regional blocks, value chains being reshaped globally. And I'd say the third one is that the markets are now less ideological based and greater shifts around geopolitics. So you find again these tensions where it's India, it's China, and these foundations are shifting and changing the market. So we're seeing that there is definitely volatility, but the volatility, interestingly enough, is not entirely reflected in the market, and I think that there are lots of good reasons why.
Okay, that's very interesting. And how do you see I mean, when we talk about volatility, and we talked yesterday a lot about volatility, and while at the same time the VIX index, which is the volatility index, which is the major indicator in financial markets to calculate volatility, the VIX is going down since April. With all this craziness, with all those tweets, the VIX is going down. How do you see this? Do you feel that the volatility is going down?
Well, so VIX, for those who are not indoctrinated in the financial world, is the volatility index. It represents, or the fear index, it basically represents what the markets think of what's going on. And I think it's two things. One is a representation of information asymmetry. So the reason it's going down, it's not necessarily because the risk is going away, it's because the information is not being evenly spread. And I think that the second thing on the back of that VIX index is that programmatic and I'd say money sitting outside today's traditional central banks have much more control. So you have almost several $1 trillion sitting in private credit, has much bigger influence on the markets today than it's ever had. And you find that the risk is being managed. So there is more institutional and programmatic play than has ever previously been possible. And basically the markets are saying, yes, we understand the risk and we think we understand how to manage it. So the risk has been priced in. The volatility is not a reflection of the risk. The volatility index, to some extent, is a reflection of information asymmetry, which is sitting today between, I think, two hedges fundamentally. One is innovation on one hand, and the other is inflation, going in opposite directions. So,
okay, thank you so much. Moving to Wael, the wizard on financial markets, and volatility is high, uncertainty is high, and this is reflected on the prices of gold specifically. A couple of years ago, people were not dreaming of gold above $2,000 an ounce. Today, it's above $4,000 an ounce, and people are betting for $5,000 and $6,000 and $7,000 per ounce, and that's crazy. It's very hard to get married in Egypt and everywhere if you want to get gold. I mean, but it's crazy, and this reflects how people are afraid. So what's your view on that? And how do you see this, while at the same point of time, the VIX, which again, this is how we have been raised to see volatility. People go to a safe haven when they are afraid. So how are they afraid? And the VIX is at that such low position. So can you highlight and shed your views about that?
Well, thank you. And I like the fact that you kept the difficult question for me. I'm not sure this is something that's less than debatable. And I also would like to hear Farouk's take on that, because his team, not immediately his team, but his colleagues, has put a price tag at the end of 2026 of $6,000 for the gold. I definitely will start from a position where I do challenge that. I think today, in today's market, gold, and I said that a few weeks back, is overbought. And there's a very simple, I understand the structural forces that led to gold being what it is right now. Definitely one of that is the trade war and the uncertainty, which might not be necessarily reflected in the VIX, how the VIX move, but there is definitely uncertainty. The only thing here is that the markets got used to uncertainty so that the VIX readings came down, but there's still uncertainty, and that drove a lot of structural buying into the gold. This is one thing. The other thing is that the speculation that took place as central banks were buying gold, there are a lot of speculators dancing around this theme and started buying gold, which all of them pushed the prices up. But there is, let's go back to fundamentals. There is a very fundamental fact here, which one person tipped me a few years back on, which is look at what is called the gold backing. What is the gold backing? It's basically the money layer, or the M2 globally. If you took that one of the most effective 7 nations in the world, and you divide that by the reserves under the ground and above the ground of a gold, you get to a number. You divide that number by the price, and it gives you an indication of where the gold is right now. That number, if you divide it, it would be a range between the 7 to the 8, that is the historical 20 years average for this ratio. Today it's at the 2 level, which is a big indication that the gold relative to the available money reserves globally is way overbought. And hence, by virtue of this being a mean reversion indicator, you can see that the gold at some point will face a lot of resistance around that level and is bound to go down before it goes up again if it ever reaches that 6,000. And this is generally my take into where we should be expecting the gold. I was a big bull on the gold at definitely the 2,000 level, the 2,500, and when the trade war started. But today at these prices, I'm not sure that the path to 5,000 or 6,000 is so easy.
Thank you so much. For people in the press, you have a very nice quote. So Mr. Wael Ziada doesn't believe gold would go up to $5,000, $6,000. He believes a reversion is going to take place. So at least when we get quoted for things that are going to be useful to the market.
And I'm happy to buy your gold.
Thank you. Thank you.
Can I jump in? I'm going to jump in.
Yeah, please.
I'm going off mark here.
Yeah, please.
I actually disagree. But so I think there's 2 things going on because we're very long gold. Gold for a lot of people has been used as a debasement trade, as in they're debasing the fiat currency and gold's going up. I think there's a bigger thing also happening though which is trade. More and more trade, as you look at what's happening in Asia and BRICS, is moving away from the dollar. We see that with BHP, a huge commodity player, just started selling in yuan for the first time. Iron ore. You see Tadawal in Saudi, they bought the GME exchange in Abu Dhabi. This is something I think in the next 5-10 years they're going to convert into a massive commodity trading entity. But I think the longer term is that more and more trade is trying to move away from the dollar. Now, if you look at just the size of trade in commodities, it's over 20 times the size of the gold market. So theoretically, if you believe that it's moving towards a non-dollar or slowly moving away from the dollar, you need to effectively have a mechanism that all parties are supportive of, and that tends to be gold right now, which is why I think you have people who are much more bullish on gold than the typical debasement trade that it's been for the last 40 years. I think my view is something's changing a little bit. A lot of it has happened in the last 4 or 5 years, and given Trump's push, it's causing other nations to start slowly, strategically moving away from the dollar as an exclusive currency of trade.
Yep. Thank you so much. That's very interesting. I know you're long in gold, Ehi. I mean, you're not going to convince us to buy gold, but please go ahead, Ehi.
I'd have to lean into that position and agree that I think on the long run, I'll go long on gold as well. I think the utility value of gold is changing, not just from a perspective as a treasury function, but into becoming a trade and a payments tool. I think with the acceleration of AI, the backing for global trade will shift. The introduction of things like stablecoins and creating that balance between risk and speed. Gold will be an extremely valuable part of that ecosystem, and I'd have to agree that I think over a period of time, as a result of that utility, we're going to see the prices actually inch, especially once you introduce payment and financial markets into that mix.
Yeah. Definitely, it's a very debatable issue. I think we can debate it for like years, but I mean, we're gonna definitely, with uncertainty, at least we have seen gold moving from $2,000 per ounce to $4,000 per ounce. We'll see where it will move from there. Farouk, you are the economic expert in this region and on global markets. And global markets are witnessing interest rate going down. And at the same time, inflation is not significantly going down. So people, central bankers, till last year were very cautious. They didn't want to lower interest rate until inflation is under check. Now, inflation is okay, but not very okay, but interest rate is going down. The Fed has been cutting interest rate over and over. How do you see this? Do you have those inflationary fears? Do you think global central banks like the US Fed, ECB will keep cutting rates?
Thanks, Omar. And just to say thank you to Dr. Abla for inviting me to this forum. It's a great honor, and it's incredible how well attended it is. I just wanted to, before I answer your question, Omar, I wanted to just address a little bit what Wael said and Karim and Iggy on gold, and also tied in with VIX. I think the traditional way of looking at gold as a kind of a hedge or a kind of a safe asset isn't really what's driving gold at the moment. It's not. I think the de-dollarization story is extremely real. I was in Asia a couple of weeks ago, and they are desperate to look to store wealth in any asset that's not a dollar asset. And so they're looking across the board, and gold is a major beneficiary from that. If you look at central bank purchases of gold, all of these things are extremely important drivers, secular drivers, got nothing to do with fear, and therefore you shouldn't expect that VIX gold kind of correlation to be still relevant. And has a lot more to do with a structural view with respect to the role of the dollar as I think, the kind of a global currency going forward. And I think that view is changing, and I think that view is being accelerated. That change in perception of the dollar is being accelerated by Trump policies, whether it comes to tariff or even to geopolitics with sanctions being applied and so on. Pushback happening from, for lack of a better word, the global south. And that is requiring people to rethink their reserve management options. So I think that's a really important factor. And as far as the VIX is concerned, you know, if you faded every Trump headline over the past 8-9 months, you've made money. It's just a simple reality that reacting is not going to pay. You basically have to fade all these big moves in the market, and that's what's driving volatility lower. Effectively, people are becoming desensitized to these big headlines because ultimately the follow-through has been relatively weak. The impact has been relatively weak from a real economic perspective. We've seen emerging market growth hold up. We've seen orthodox policy across most emerging markets. Low inflation, high growth, orthodox policies has been a real benefit. Now, coming to your question specifically, it's another driver of emerging market growth where you have a decline in the U.S. interest rates, in core interest rates. We expect another cut of 25 basis points by the Fed in December, and then a slowing of the pace to a quarter point cut in March and another quarter point in June. And that's really a reflection, I think, of in the US, there's on either side of the ledger, you have still relatively sticky inflation, but that is being downgraded, not so much of an issue. What's much more of a concern is the jobs data, which are much weaker, and the implications for the US economy as a whole. And so we expect that to continue to come down. We're not expecting, though, a recession. And so when you have a weakening in the economy, no recession, inflation that's manageable, albeit at a slightly higher level than the target, and falling rates, this is a fantastic environment for emerging markets more generally.
Very good. Thank you so much. Mr. Minister, you're very happy. You're obviously very calm. You've pulled together a very big turnaround on the macroeconomy, so you ought to be proud. But this question is for you as an economist, not for you as a minister. How do you see inflationary pressures all over the world? How you see interest rates playing in that? And you're a very big follower of economic news. How do you make sense of this as an economist? And how do you see this as a minister then affecting your capability to borrow at rates over the long period, because you borrow at different maturities? So as an economist, how do you see that, and how do you deploy this for your debt schedule?
Thank you, Omar, and thank you for the invitation. I'm very happy that this Cairo Forum is now beyond an idea. It's the second year and a very good start. So we're very happy and proud of that. And the attendance today is great. So thank you for allowing us to be part of this forum. Egypt needs this and needs this to be regularly and to be expanded. So a great, I just want to applaud really the people have been around that. It's not easy to arrange for those type of big conferences, but a very good achievement. So I'm happy. And also I'm very happy to be with this panel. They are all very close friends. I have a new one today, but with the rest, I think we have been engaging in discussions throughout the years. And I love the question. First of all, I'm very happy that I'm not answering a gold question. So that's very interesting that people talk about gold. I will talk about things that might be of equally interest to finance and ministers of finance. In general, I will be very frank. I think it's a tendency everywhere. Very important, very, very important to talk about inflation, to keep it in check. But I think there is huge bias for inflation fears against economic fears. And it's a general concept, I see it everywhere. You talk about stickiness inflation that's going from 3 to 2.5. But you ignore that there are millions of people that are waiting for jobs and that is equally needed. I'm not underestimating the importance of keeping inflation in check, but in general, I feel that there has been in news, in analysts, in experts, huge focus on inflation and how to bring it down, which is a very, very important and needed target, but equally talking about the economy, about job creation, about the competitiveness of the economy from an emerging market perspective is equally important. And I think it's a point that I feel that is worth mentioning. I will tell you two comments in general related to this question. The first is that despite the tightening that we're seeing over the years, it's starting to see some easing in general, but in general, still the cost of borrowing is quite high. There are one clear reason for that, but it's just basically ending into a vicious circle for emerging market, which is the very high public debt. That's something that is adding fears, that is adding risk profile, that is adding, because basically, to cut it short, as simple as that, if investors are seeing that growing significantly, and the trend is an upward trend, they are always betting on measures that will be taken in the future that will bring inflation. So then they are putting or adding a risk premium there. So that's something that emerging markets is adding to the cost of borrowing. But on the other side, we are seeing also other cases where emerging markets or investors interested in emerging markets or funds that's coming to the emerging market are also differentiating. They are also acknowledging reforms. They are acknowledging better stories. They are acknowledging also better prospects and good policies. So you can see this differentiation happening. I will give you one example in Egypt case. And that happened despite the very delayed rating decisions. The very delayed rating. So markets and investors were much more agile, much more forward-looking than institutions. We saw our yields on the secondary market, our international bonds, coming down significantly by maybe from March, maybe by 3 or 4%, 300 or 400 basis points. 80% of that came before the rating decision. So it tells you that investors also they dig deeper. One key message that helps related to the information asymmetry is the quality of the information that you avail to investors, the periodicity, the availability to be there to explain it, the trust that you build over the years. It always makes a big difference. in the risk image. So in general, I think inflation I feel that it is in a good shape. I don't see it at a very sticky or high. It's compared to where people want to see it, but in general, I think it's in a very good shape. I think what we should be more concerned about is debt and job creation. And I think both are very, very big challenges for emerging markets, including Egypt. But again, investors differentiate. They can digest things much more, I would say, with a deeper analysis and with a more forward-looking analysis than other institutions that are a bit lagging. But markets so far have been treating us quite well. So that's what I can say.
Very good, thank you so much. Karim, you are the investor, you're one of the biggest investors in emerging markets and definitely in Egypt. With all the turbulence happening around the world, with everything we have talked about, how do you see the flows of funds getting into emerging markets, whether in debt markets or in equity markets? And specifically, how do you see equity markets doing over the coming couple of years? Are you positive, are you negative? And we're talking general emerging markets and definitely the MENA region in specific, not only Egypt, but I mean the MENA region. If you want to highlight more on Egypt, this comes later on.
Well, pleasure to be here, first of all. I'll start maybe by talking about the US, since that's the largest market, and what's happening there and how the ramifications are for emerging markets. So if you think about the last, I don't know, 15, 16 years, US markets have been moving higher and higher. The US dollar has been very strong. I think at the end of last year, the US represented over 67% of the MSCI World Index. I mean, that's an unbelievable number if you think about it. So if you've been a foreign investor, if you've been an emerging markets investor, you were generally better off investing in the US and leaving your money there. You had higher earnings growth versus EM. You had low interest rates, and you had money flow because of what tech was doing. Tech was having high earnings growth with very high returns on invested capital. So, you know, if you look at the last 16 years, emerging markets was basically not a place to invest. What's changing and why I think it may change more significantly now? So the US right now is entering a period where, you know, we all hear about AI, tech dominates the stock market in the US, Magnificent Seven. But if you look at sort of what's happening, if you go back 10 years ago, you know, the big tech stocks, they used to spend 4% of their sales on CapEx and used to grow about 25%, you know, about 15% of their operating cash flow. Today, that's closer to 60% of their operating cash flow is spent in CapEx, or 12% of revenue. And you have a situation where growth is now for the big companies closer to 15, 16%. So you had these businesses that had huge moats, generating very high returns, very high growth. You could buy them and hold them. And now that's changing because of AI. There's basically, it's a view that one player takes all and everyone has to spend like crazy to catch up. And the markets are generally giving these big companies the credit or the belief that they can succeed because they've succeeded for the last 15, 20 years. So that's one thing that's happening in the US. But then you have on the, you know, the macro side, you have a US government under the Trump administration that's trying to move a lot of investment into the US because of what's happened in the middle, you know, the middle class, the working class has been hollowed out. The view is because of China, even though I would argue that the US sort of created that environment. So to do that, the problem is in the US, things are so expensive. It costs 1/4 to 1/5 to build something in China that it does in the US, and it takes about 1/3 to 1/4 of the time to build it in China versus does in the US. The US effectively has to bring down the value of the dollar. It doesn't mean they don't want the dollar to be the reserve currency, that, you know, it can be both reserve currency and weakening, but they want to weaken the dollar. So that's one of the big reasons why this is a very natural flow for emerging markets. Emerging markets will benefit from a weaker dollar because effectively in emerging markets like Egypt, you can start cutting your interest rates much more rapidly because the currencies are appreciating. This year we've seen what, 27 to 21? And more to come probably, and the currency's been rallying actually versus the dollar. So with that backdrop, my personal view is I think emerging markets are probably better positioned to outperform over the next coming period But my big concern short term is I think the US markets are, I'm not going to say AI bubble, even though you'll read that a lot, but I think if you look at what's happening at the AI companies and the tech sector specifically, valuations have risen a lot. People are paying higher multiples for effectively businesses that are not on financial metrics as attractive as they were 10, 15 years ago. They're just very big companies. And because if you look at the US, what's happened also is passive investing changes a lot of things in the US. You know, if you go back 15 years ago, passive was like 5%. Now it's 53% of the market, and it's growing 3% a year, which means as these stocks go, you have to keep buying more and more and more of them, regardless of fundamentals. So fundamentals have taken a somewhat backseat in the US market. So going to emerging markets, I do think they're in a position to outperform because I think flows will move more towards emerging markets. But the concern I have short term is that we may get a pullback in the US in the next several months or 6 months, and that may cause everything to come down before it continues to calibrate back away from the US.
Yeah, thanks. That's very insightful. Farouk, you're here, so we have to ask you, what's your view about emerging markets in terms of their capability to attract funding, especially in the debt market, with the current economics, macroeconomics, and definitely would like you to highlight on Egypt, but also would like to get your impression about the rest of the region, the GCC, what's happening, and their capability within this macro situation, whether macroeconomic or macro-political. So how do you see the outlook for the coming years, not on equities, but on the debt market and the flows of funds?
I won't repeat myself in terms of, you know, the environment being very positive for emerging markets generally with lower US rates. What the factors that Karim was talking about are also extremely important. So, I mean, the backdrop is extremely positive. Within emerging markets, you know, our region, I think, is very well positioned for a number of reasons. You know, when I talk about the Middle East area, I think from a tariff perspective, we're seeing some relocation of supply chains to the region, which I think is extremely helpful. I'm seeing very strong trends in downward inflation, upward growth across the region, which is also very helpful. Helped, yes, by a weaker dollar, but also by improving policy, improving communication, and maturing in the markets in the region. And, you know, Minister Kouchouck was talking about the communication aspect of it and the transparency aspect of it, and I don't think we can underestimate quite how important it is that every time Mr. Kouchouck is in London, we sit down with investors and we talk through issues very openly, and we bring investors here all the time. I think it's a really important dialogue, and clearly that is having very important benefits. But the fundamentals are key here. And in Egypt's case, I think, you know, I want to talk a little bit about Egypt because we're here. I think in Egypt's case,
yes,
the fundamentals have improved enormously, starting, of course, with the unlocking of the issues that we had up until sort of February, March of 24. We've seen a return of confidence, but we've also seen a very significant improvement in the policy environment, both on the monetary side and the fiscal side, supported, of course, by an IMF program, but we have to remember this is a homegrown program, and this is the impetus behind the program and the policies that come behind the program are devised here in Egypt. And this has been very, very important in engendering confidence in the Egyptian policy-making environment. And we're seeing that, you know, in terms of the capital inflows that we're seeing, both in the portfolio inflows, but also in the foreign direct investment pickup that we've been seeing, and importantly, in the reaction of locals. If we think about trends like de-dollarization in the local market, if we think about the consumption trends in the market and how those, you know, that confidence is palpable. And I've been doing 2 days of meetings in Egypt, you know, now. I can tell you in January, we asked people where the pound is going to be. They said 58, 59, and we're at 47. So the and the sentiment has improved dramatically. However, I cannot leave without sort of saying there are still risks on the horizon. One of them is complacency, and there's always a risk of self-inflicted wounds. I think that any letdown or any loosening on the policy front, be it fiscal policy or monetary policy, and I'm sure, Ahmed, there'll be no such thing, but I'm saying that there is still a capacity for self-harm through bad policy decisions. And so that's a very important, regardless of where the IMF is, regardless of, after the program, staying on a policy path that is orthodox, consistent with what markets are expecting, I think is an extremely important part of it. And then we also have to look at the structural vulnerabilities that still exist in Egypt and other emerging markets, the trade deficit, the energy problems, deficit that we have. These create an underlying vulnerability that hopefully we're not going to see any external shocks, but if we do get an external shock, if we hit some problem, we get a shock to tourism, we get a shock to remittances, we can quite easily see many of these gains be eroded. So we have to be mindful of these vulnerabilities that are underlying and continue on the path of trying to strengthen the resilience of the economy, building the export base, bringing down that trade deficit, improving the flow of capital coming into the country, and so on. So I would really caution against complacency.
Yeah, that's very interesting. I want to have a follow-up question to you. I know you have a flight to take, and I want to make sure we ask you this question before you go. You cover the region. You don't only cover Egypt. And the region is interconnected. It's very hard to look at Egypt without looking at its allies, the Gulf allies that have been supportive to Egypt over the last decade. And with what has happened over the last year, Mr. Trump had a roadshow, I would call it, and he collected more than $2 trillion. The best investment banker couldn't have done it. So $2 trillion have been pledged to invest in the US over the coming decade. This is getting out of the pockets of the region. And how could the Gulf countries, which are very instrumental for the region, keep up with their own visions, which are very ambitious, and also keep their support to their ally, which is Egypt? How do you see this playing out?
My first reaction is he collected promises of $2 trillion. He didn't collect $2 trillion. I would be very surprised if that actually materialized. So that's my first reaction to what you're saying. Secondly, I think that we've seen in the Gulf countries a very significant maturing in their attitude towards investments abroad. Okay, there are still cases where geopolitical drivers, and we're looking at Lebanon and Syria, for example, now as far as Gulf investment is concerned, they're still very important drivers of the investment decisions that the Gulf countries are making. But by and large, as MBS and others have said, it's business. It's about return on capital. And the Gulf money is not stupid money. It's money that's going to come in and take advantages of significant business opportunities. That's why Ras Al Hikmah happened. It's a very good business proposition. That's why Ras Al Alam in Rome is happening with the Qataris. These are purely commercial investments, and as long as Egypt is able to continue to provide these value proposals on that front, it's going to succeed in attracting more investment, but not just in land sales. There's huge opportunities of attracting more Gulf investment across the board, across the region, and in Egypt. The second thing I'd say on the importance of the Gulf has been the remittances. I mean, we've seen a huge improvement in remittances from maybe 21, 22 billion at the low point to now 37 billion on an annualized basis. And those remittances are largely coming from the Gulf. Why? Because we are exporting more brain power. I mean, that can be you can see it as a good thing. We're exporting more brain power. You can see it as a bad thing, as a brain drain. But more and more Egyptians are moving to the Gulf countries, particularly Saudi Arabia, and remitting more and more of their hard-earned cash to this economy. And that is going to continue and provides very, very significant support. So the support that we get from the Gulf, be it through tourism, be it through direct investment, or be it through remittances, is extremely, extremely valuable for the Egyptian economy.
Very good, thank you so much. I told you you're gonna leave at 2:55. It's 2:50, so I'm 5 minutes before schedule.
Thank you
so much for having. He has to leave. The rest are here.
Sorry.
He has a flight to catch. We're continuing with the panel. Thank you so much, Farouk.
Thank
and
you,
we wish
and
you a good
I'm sorry. Thank you.
Please, thank you, thank you. We hope traffic would be on your side, so we wish you the best of luck. Wael. Getting back to the emerging markets, getting back to our region, with all this being said, how do you see our region performing in terms of equity markets? How do you see specifically the most important markets, Egypt, Saudi Arabia, UAE? Do you see them doing well? Do you see the coming couple of years? Will we have a rally, a big rally, not very much, downside? How do you see this?
Okay, thank you, Omar, for that. Well, I'll start from where Karim ended, which is basically the next year or the next period we'll see outperformance of emerging markets versus the US and some of the developed market. We have seen the US and Europe actually has done a staggering comeback in the last 12 months. I think for all of the reasons that Karim cited, I believe that emerging markets as an investment class will outperform. But again, this is not going to be homogeneous. This is not going to be across the board. There will be markets that underperform, markets that will outperform, and definitely markets that will remain in line with the overall performance. If we look at Egypt, I'll start with Egypt. I think Egypt has done in the last period most of what is needed to start attracting back capital and have all of the macro indicators has improved significantly. Yet, you need to look at Egypt still if you're going to discuss the equity market from the perspective of an equity investor. Now, the equity investor looks at size, and size matters a lot for these markets. You cannot ignore the devaluation that has taken place over the past few years, which has reduced the size of some of the companies that they look at and some of the turnover that they look at. I'll recite a conversation between me and Karim in 2002 when we first met back in New York, and I was pitching him one company, and he told me, look, does it trade less than $10 million a day? If it trades less than $10 million a day, I won't be able to buy it because the minute I go in, I'll take the stock up 4 or 5%. This is not something that I do. Now, if we look at this $10 million
but we
a day...
did. We did.
Yeah, that was back in 2002. Now, if you look at this today, this is the equivalent of roughly $500 million. 500 million pounds. Now, how many stocks do trade 500 million pounds a day? Only until yesterday, perhaps with the resurgence of a couple of stocks, we didn't have any. I mean, it happens every now and then, but not a lot. So again, this is a challenge. And the only way to fill this size gap is to continue with these consistent reforms that will empower growth in these companies, keep the currency where it is, and the market will start re-rating and then attracting once again the large foreign institutional investors, because they are the bellwether, or they are the balance into these markets. And we have seen them, frankly speaking, exiting, not coming over the past period. Now, if you look at the other markets, which is the Gulf markets, Saudi, obviously with the mega fiscal stimulus that they have been putting in place in the last few years, Saudi has become the most active capital market, not just in the region, but perhaps in entire emerging markets. There's an IPO or a couple of IPO, maybe 6 IPOs every month. There is, all of the big money is moving there. And by the virtue of this, you will have to have a re-rating. The CMA has been engaging with investors, deregulating the market, opening up to things that hasn't been thought of in the past, and you have seen money flowing, and for sure the valuation is going to be higher than what it was over the past period. It has seen its fair share of beating, but it's coming back, and I think also 2026 is going to be a year where many of the Saudi equities are going to re-rate. UAE has been steady, increasing slowly but steadily, less volatility, and it's been one of the most stable markets over the past period, and I don't see any reason why that should change. So overall, these three markets that you mentioned, I still believe that they are going to be the core performance of this region for the next period.
Thank you so much. We hope so. We hope to see that rally taking place. Whenever we talk about emerging markets in Egypt, we forget Africa. We forget that we are Africans and we are very much related to Africa. So, Ehi, we want to listen to your views about how are markets in Africa foreseeing these coming changes in terms of emerging markets? How do you see the coming year or couple of years in terms of flows of funds? In terms of your beloved topic, remittances, how would remittances be doing? How would general flows of funds be doing in different African countries? Egypt is Africa for sure, but I mean different other African countries that we don't talk about, like Ghana, Kenya, Nigeria, because it's very important, and Dr. Abla always stressed the fact that we have to talk about Africa, we have to talk, so here we are talking about Africa, so but that's very important for us.
Thank you. I think it's an excellent question, and I think the African narrative prior to this year has largely been shaped by FDIs. So people think of FDIs and aid as the primary definers of Africa's markets. What we have found, though, is that remittances account for a much larger part of flows into Africa than both FDIs and aid, and this represents Africans betting on Africa. So it's money in the global north moving back home because Africans are supporting Africa. We're also finding that when these sort of, when instability increases, actually remittance flows increase, because then you find that more households depend on these global flows to support. And especially with the pulling out of aid money, it's a huge blessing in disguise. So first thing is short-term pain. Everybody reflects with the initial loss of what seems to be easy cash. But that very quickly is transitioning into big questions. So you have that money sitting on the continent, it's asking itself, what are we going to do with our cash? And with markets retreating in I mean, stock market is growing in the US, but the trends obviously are that the dollar in terms of its pricing is going to retreat. The smart money in Africa is asking, what do we do? And the short answer is we bet on ourselves. So it's a huge blessing in disguise. We expect that capital markets in Africa should see more liquidity. And from a broad perspective, markets are shaped by liquidity. I mean, period. The UK is struggling with its capital markets now because liquidity is fast leaving the UK and it's heading into emerging markets. And wherever the money is, the markets will perform. So we're seeing this increased flow of capital coming into Africa, but not through the traditional sources. And the challenges and the opportunity, it's basically turning these are massive remittance flows into working capital for both trade and financing the underlying businesses. Now, as these emerging market currencies, or frontier currencies as they tend to call, strengthen, then it makes it a lot more attractive for local market investors to bet on our countries. And this is a huge blessing in disguise, and actually a really great opportunity for us to galvanize and transform our local economies. So I'd say short-term pain, the initial shocks were very painful, but I think that the overall long-term horizon, if we can seize the moment, will be extremely beneficial for the continent.
Yeah. Hopefully so. Mr. Minister, again, I'm asking the economist in you, but also the minister as well. The current cabinet and the current direction is to focus on building proper links with Africa. Africa is lately becoming an important topic. We hear the word Africa and African countries much more frequently in the news, and we hear you talking about Africa and relations, and we want to be hub for Africa. So looking at the current situation, how do you see Africa? How do you see the flows of funds? How do you see that these countries can import from us, which makes us the export hub, which the government is trying to do, and I'm sure you are on top of this and engaged heavily in that. How do you see this happening?
Well, Africa, and you're right, we're African, and we should always remember that. I will tell you that over the last couple of years, where Africa is part of the topic or the discussion that we're having with a lot of investors. And to be frank, most of the time it is coming in that context. It is coming in the context that a lot of countries, a lot of firms, a lot of establishments, a lot of financial institutions are trying to diversify, and they know that Africa is a huge potential, and they are looking for markets that they can use as a base for Africa. And Morocco did very well there, Nigeria is doing quite well, Egypt is doing quite well to serve as a potential hub for international institutions that can use those countries, African countries, as a hub for Africa. Leveraging a lot of things, the proximity, leveraging the free trade agreement, despite it's not always working as smoothly as it should be, but leveraging a lot of other issues, the knowledge, the proximity, the ability to do. So we are seeing a lot of interest in Africa, but unfortunately it's not yet equally distributed. It's still, people are searching for markets to be a base for them to explore the countries and the region and the continent. And I think from that perspective, we're seeing a lot of interest in Egypt recently for being a manufacturing hub for Africa as for the region, the MENA. But also we're seeing this becoming more and more interesting or a common interest by firms when they talk with us. So you can see it. You can see it in a lot of the talks, in a lot of the discussions. We're seeing it also when we talked about or when we're discussing export promotion activities. We have a program that we double it and we're trying to build on it, but you are seeing a lot of interest by firms to select. Some of the features of this program is to cover part of the transportation cost. We're seeing a lot of firms asking for that, rather than asking for anything else. We're seeing also a lot of interest to have more insurance and more protection and more coverage there. So you start seeing a real interest. But in general, as an African and as one of the African countries, Egypt, we are seeing also a big, I would say, appreciation by investors for diversity and for diversification. Remittances is very important, by the way, and it's very important for a lot of the countries in the region and in Africa, but also I see that investors value so much the diversification, and they give much more weight when they see countries that have the resilience, that they have the multiple funding abilities, that they see always that you are ready, that you have alternatives, and it's very important, by the way, because people think that opportunities come and that you need to grab it, but you have to be ready. It doesn't happen like that. It doesn't happen that you want to go and explore and diversify and to open new markets. It doesn't happen overnight. You need to do a lot of preparatory work. So this is something also that I feel that we are lacking in the African continent, that we are still on the recipient side, not proactively going and searching for opportunities, convincing others. We're waiting people to come to us. In general, I'm not talking about Egypt, I'm talking in general for Africa. I think one big advice for the continent is that we need to be more proactive and we need to create more synergies and complementarities. But I cannot also miss to say something about Egypt. So I want to say one thing related to the flows of funds and some of the comments was mentioned. I cannot agree more that we need to keep the good policies. We need to keep building the resilience. We shouldn't be overreacting to improvements. Improvements are great, much better context. It should give us more ambition. It should give us more desire to do more and to preserve stability and to keep the right things. Secondly, I always say to myself, basics are needed always, and they are the most impactful things. So doing the basic things, doing the right things shouldn't be underestimated and shouldn't be taken for granted, and we should preserve that, and we should keep all the right things to keep it, because also things can move, things can be very fluid at any point of time. So I think, again, we should keep the right policy mix, we should keep the right momentum, we should build on that, and we have a long way ahead of us to do more and more reforms. But coming back to the flows of funds, I think that, one thing that I can tell you is that beyond the traditional funds and the traditional flows, I see huge amount of also an ample funding in the East that is looking for new markets. And in our case, couple of previous examples were really impressive in terms of the cost and in terms of the size that we can get. But you have to start to work on it from now. I'm talking here to my African colleagues, because they don't come as quickly as other funds, but they are also very sticky and very cost competitive, which is the East, China, India, Japan, and the rest of those markets. And they have ample liquidity, and they're looking for inflows and new opportunities, but they need you to be there. They are not coming on their own. You need to be proactive. You need to do a lot of non-deal roadshow. When we did the Samurai issuances, when we did the Panda issuances, people were very happy that we did it, but they didn't know that we started 2 years ahead, and we went there several times. We had to build the relation. We have to build the relation with the regulatory authorities there. But then, after doing that, and after doing first and second issuance, then you start to be present and you start getting the attraction. So it's a big advice I would mention to the entire continent, that we need to be more proactive, and we need to look a bit east also, because this is huge amount of money there that is looking for new markets.
Yeah, thank you so much. That's very insightful. Karim, we get back to Masr, to Mid-Dunya, to Egypt. So we're going to focus a little bit more on Egypt for the coming 30 minutes as of the session. So looking at the market here, I mean, we're very dependent on remittances. I mean, remittances are very important for us. Lately, we have been very dependent on flows of funds coming from the Gulf. So we got money from the Gulf for Ras Al Hikmah and a few other projects, and they were very crucial and detrimental in doing the turnaround. And we are trying to attract some FDIs. Plus, hot money is a critical component of our balance sheet or our trade. I mean, our overall scene. How do you see Egypt faring around that? I mean, do you see things in Egypt, and specifically in Egypt, with all those dynamics? How do you see these things playing out as an investor, and how do you see the landscape for that?
As equity or fixed or both?
In general, how do they affect, and what's their effect on equities, for sure?
So,
because we have seen when things are not doing very well, equities do not come.
Yeah.
So I've started to learn, I want to make sure that debt investors are happy, because then equity investors jump in.
I was going to say, if the debt investors are not happy, there's no equity investors. But you know, Egypt's in an interesting situation. It was a country like Nigeria that locked up its currency for some time. And so a lot of foreign investors left Egypt the minute it was opened last March, April. So you saw a big exodus initially. We started coming in much larger size then, but Egypt's interesting because the fixed income market is one of the most attractive markets in the world. I mean, the carry trade here is very high. If you look at markets around the world, you have Egypt, Brazil, Nigeria, Turkey, high real interest rates. Turkey is an exception in terms of there's political interference, so people haven't really put money there. But Nigeria, Brazil, and Egypt have attracted a lot of money, and because of what's happening with the dollar, emerging market fixed income funds have seen some of the largest inflows in the last 20 years this year. So those funds are all doing very well. If you think about it, you get 10% from the currency, from the dollar weakening, they make 10%, plus years bond yields of like 15, 20%. So the real returns are very, very high for these funds. They're showing strong numbers, they're getting inflows, they're investing, and their money is coming back into Egypt. That's why, if you look at FX reserves, I think they're what, 49.5 billion? Net foreign assets are 20 billion now here. So as a result, you've had a lot of dollars coming in, the currency's strengthened. I think that will continue to be the case in terms of money coming into Egypt. The concern I have is the currency. I don't want it to get too strong because you have too much imports relative to exports, and that becomes a cycle we've seen before. But as they cut rates, initially people put money into fixed income. The equity investors are more passive, the larger ones. And as those rates keep coming down and they continue to see stability, money will start coming into the equity market from abroad, from institutions. Institutions that were burned, it usually takes them 2 years to come back in, historically, I've looked at. So I think it's going to take them some time. The GCC money will come in before the big foreign money, but the foreign money will come in if rates keep coming down. And you also get the domestic rotation from fixed income as the CDs start paying less money returns. Some of that money will migrate also into equities, I think. The challenge for Egypt, and we've spoken about this before, is having enough quality companies in the stock market. You've had a lot of great companies leave the stock market or migrate over the last few years, and I think the challenge is to bring new names to the market, quality names to the market, because the valuations here are relatively attractive. It's just bringing quality and size. That's the one thing I think is missing when I look at this market relative to EM. But in terms of Africa, and I'll just say one last thing, just to give you some interesting information. If you look at the last 15 years, frontier funds, which is active funds, lost 85% of their assets under management. I mean, that's incredible if you think about what's happened on a nominal basis in the last 15 years. They lost 85% of their money because performance was so poor. This is the first year they've seen inflows. I think that continues, and if that continues, you should see much larger money flows moving into markets like Egypt. It have nothing to do with the government, even though I think the government's doing a great job. It's going to be a flow trade, and I think that flow trade is probably something that continues for a number of years. Exception being, I think the US may at some point have a correction that impacts everyone, but thematically, I think it continues to benefit.
Yeah, that's very interesting. I want to ask you a follow-up question for that, to keep the line of thought. As you look into Egypt and the flows of funds, I mean, we're very much in line with or we're very close to our regional allies in the Gulf. But as I was just asking Farouk a bit ago about the pledges made to President Trump when he came here, plus the very, very, very ambitious visions in Saudi Arabia, very ambitious visions, the very aggressive spending on AI and infrastructure that is happening there. Aren't you worried as an investor that not enough funds going to be flowing to Egypt, and accordingly this will affect the macroeconomic situation in Egypt?
Quick word, no. I'll tell you why, though. If you look at the commitments the Gulf made, Saudi was what, 600 billion, Qatar was 1.2 billion, 1.2 trillion, UAE was what, 1.2 trillion. A lot of these are, transactions that will never see the light of day, in my opinion. I mean, a lot of these are, we're buying from Boeing, we're buying from GE. These contracts are adjusted over time. The reality for Egypt doesn't need anywhere near that size of money. So $10, $20 billion makes a huge difference in Egypt. I think even bigger, though, is Egypt's not just going to benefit from GCC money coming in, but If you look at China, Chinese are exporting more now than they were before. They're just exporting much more to the emerging markets than they are to the US. So they're looking for new markets to invest in. And Egypt is a natural hub for exports into Europe, exports or trade throughout Africa. So I think you'll see a lot more of that developing over the number of years. I think the other thing is also, if you look at FX reserves, since 2014, foreign countries have not been buying treasuries. And in the last 4 or 5 years, they've been trying to migrate and reduce their exposure to US treasuries. What that means is they have to invest in different ways. One of the ways they're investing is they're investing in countries where they have similar views and standards and culture. And so again, Egypt will benefit from that, from countries like the Gulf, like China, like India. I mean, Turkey is investing in Egypt because Egypt is so low cost relative to Turkey right now, which is something I would not have thought I would see before. So I just think that Egypt is uniquely positioned as long as they maintain the monetary policy, orthodox monetary policy, and again, fiscal, conservatism. The money will be there.
Yeah. Speaking of policy, as we speak about Egypt, we have to ask the minister now in his capacity as a minister. And I think everybody has talking about how the situation has improved significantly. The numbers do not lie, as they say. The fact that we are sitting here, there is air conditioning, there is lights, we're having a great chat, you are smiling. You always smile, but now you're very much smiling. You seem to be very calm, you're happy. You have just finished the issuance of a big issuance of Sukuk. Things to be working quite well. In terms of risk management, because we always, as you have mentioned a bit earlier, when things are doing very well, we turn to be complacent as human beings, and there's not enough risk management. In terms of risk management, and in terms of the mix between hot money and FDIs and the flows of funds, how do you see this? How do you see this? And how do you see the potential risks, and what do you see as mitigation that the government and specifically the cabinet and specifically the Ministry of Finance has learned over the years from, because we have been through very tough experiences not very long ago. The last 10 years have been actually 15 years have been very problematic. So what do you have in mind when we talk about risk management and this game plan?
It's good to speak as the minister. It's even easier, by the way. And I really enjoyed the discussion today, and a lot of what is being said. By the way, we have been talking about it for years. But let me, before addressing your question, I want to say something Karim mentioned. Yes, we should be focusing in the next period on some incentives and some proactive policies that can bring quality and size to our stock exchange. I think we have a great regulator. We have a very good reform that has been done. We have a good I would say backdrop and context and global context that should bring more funds, but we need size and we need quality. And we need to come up with more proactive. It will happen over the years, as Wael was saying, but while this is happening, we need to also accelerate it and also augment it. And this would require some proactive policies. And I think in the second facilitation package that will be presenting very soon, we will have some measures for the stock exchange and for making more attractive and more, I would say, more tailored incentive for listed companies and for newcomers to come. We will try to also learn from previous, I would say, challenges and come up with something. But also, we're not doing it in isolation. We'll come up with the facilitation package very soon, and we'll be open for debate, and we'll benefit from the discussions, and hopefully the final package would be much more capable. But this is a principle. We'll be coming this month to announce the package. It's not driven by or mainly focusing on stock exchange, but it will be, part of it will be for that, and there will be a lot of other measures. Then coming back to your question, so I will tell you two things. One principle based how to do better risk management, and secondly, how more policy oriented or more actionable things that we'll be doing to address this question. I think the first one is something I want to highlight as a fundamental shift in how we as the Ministry of Finance as a team, I have the entire team with me today here, we're thinking together about how fiscal policy should be run and how this should be, I would say, have more impact and more influence. We believe fiscal policy should be a balanced one, and that we should be accountable for both discipline but also for supporting the economy. We shouldn't be focused only on getting the fiscal in the right place. We will keep doing that for sure. Nobody take it as that we are diluting that or limiting the importance of that. Discipline and protecting the fiscal position is key. But our role is much bigger than that. Our role is really also to look at the entire economy, how to support the economy, how to come and support experts, how to support manufacturing, how to support investment, how to facilitate others' work. And that's something I want to highlight, because it's not something I'm mentioning today. We mentioned it since the day we came as a team. We said we set 4 key principles or pillars for fiscal policy. The first is building trust and regaining trust with the business community. Secondly, a balanced fiscal policy, and this is what I mean, a policy that is treating equally the fiscal discipline with economic activities. Why I'm mentioning that? A third is that, which I'll talk about, and the fourth is how to create space for more social protection and social or human capital spending. But why I'm mentioning that? Because this is the best risk mitigation mechanism. Having a good economy is your best ally, the best, I would say, assurance that you will be able to do, and much easier to do and preserve fiscal discipline. So you need to keep this in mind. You need always to support the economy and do more there. And by the way, take last year as an example. We did facilitation, we did trusting measures, we did 0 increases in the burden, and we were able to increase taxes by 36%, the highest growth since 2005. It was all through better economic activities. A lot of the people here in this room have contributed to that. They are, by having a better performance on their side, that led to better performance on our side. So I think this is one issue. The second is how to also ensure that what we have will protect and will build on. I think one thing that we want to do this year, beyond the second facilitation package that we'll be doing, whether on the property tax or the customs or the taxation side, but beyond that, what we're going to do is that we'll be issuing to the public and to the business community, local and international, a medium-term context flavor of what we want to do. So we'll be coming with our medium-term debt strategy before that December, to be followed by our medium-term tax strategy early next quarter, Jan-March, for public consultation, and before, of course, March, we'll be coming with our medium-term fiscal strategy. And the idea here is to give people predictability, clarity about our ambition, about our targets, about how we're going to do that, what they should be expecting, what they shouldn't be expecting, to give color about fiscal policy going forward, where we want to see the debt, where we want to see the debt matrices and debt levels, debt services, how we're going to see the tax collection efforts, what are the key pillars there. So one thing that we'll be doing is that we'll be coming and sharing our medium-term perspective very soon across the key measures and the key issues. We're hoping that this will give clarity and predictability and give people more flavor of what we're doing. And the final thing I want to mention is that we as an economic team, I think there is a lot of harmony, and it's a genuine harmony, by the way. It's a genuine harmony, and it's really working well. And I think it's a big asset that we need to keep and preserve and build on, because it makes huge difference when we're working as a team and we're working to support each other. And as the Ministry of Finance, because we have a lot of tools, I think this shouldn't be underutilized. We will be backing our ministers to do more investment promotion, to do more export support, to do more industrialization, to do more manufacturing in Egypt, and to do that while keeping the stability and the discipline for sure.
Thank you so much. It's very hard to have a panel and not mention the word AI. I think it will be a cardinal sin if you don't talk about AI and its effect and how it works. So we have the question to the beloved of AI, Wael. We are in an era where AI is leading growth, and this growth does not necessarily come with jobs. Looking at this, will the emerging markets in general benefit from this AI boom? Will Egypt in specific, which has been trying to be the back office to some of the back end manufacturer, will we benefit from this, or it's going to be a doom for us? So is it a doom, or is going to be something positive? How do you see this? Will AI be something that we could bank on, or it's a curse for us?
That's a very difficult question. I mean, in a global context, obviously the merits or the advantages and the disadvantages of AI are very clear. But when you look at from an Egypt context, it's a little bit tricky because one of the significant advantages that the AI is given is efficiency, and enhancing efficiency means some job creation and some job destruction. But again, we cannot look at AI and say, okay, AI will destroy jobs for the world. I mean, that's the same argument that you had back in 2000 with the internet, and everybody thought the internet will definitely destroy jobs. But between 2000 and today, the job market globally has grown by more than 60%. Now, also back in the 80s, the same argument went with the advent of computers, the PCs. Everybody thought that they will destroy jobs, but they created jobs. So, but not necessarily the same job was created, but because of increasing efficiencies in areas, in certain areas, there were jobs created in these areas and jobs destroyed in areas. But overall, the job market grew. If you look at the advantages, the labor market, the Egyptian labor market is still in an area where AI is not going to impact that significantly. So still, in that regard, if the question is, are you afraid that AI will destroy jobs, and that's Egypt's most inherent advantage, which is very economic labor, the straightforward answer is unlikely. But AI, let's not forget that, is very dependent on power. And without power, AI cannot, because AI is increasing significantly the demand for electricity, the demand for energy globally. And this is a region that's awash in energy, and Egypt is no exception. So again, Egypt has some advantages locationally, geographically, and in many areas that can use AI in improving. But I think the more interesting question in that is how Egypt today, with the technology stock that it has, or technology inventory, is ready to receive AI.
Thank you. Ehi, looking at I want to move into the last part, looking at the economic situation in Egypt, but also from the geopolitical angle. We always used to pride ourselves in Egypt that we are much more stable than the rest of Africa, that North Africa is very stable. But if you look at us, we had a humanitarian crisis and a war to the east border. We have a crisis and a war in the southern border, and we have a country in limbo on the western border. And as our chairman, Mr. Omar Mahanna, during the last time we did the session, about financial market snapshot, he was highlighting how the situation in the region was agitated. Now I want to hear the view of somebody who is not from North Africa, who's from Africa but North Africa. Are you positive about that? Don't you think that this situation is very risky? You're coming to Egypt, you're looking to expand your business, you're looking to expand your stable coins and all those innovations?
So the short answer is no, we're not concerned about Egypt.
Okay.
Short answer. I think Egypt occupies a unique position in the world, very unique. It's in the middle of the Arab region. the GCC. It's also a part of Africa, and it's on the edge of Europe and North America. So it's, in a sense, it's at the center of, it's a confluence of many different markets. And I think it also represents and sees the tensions around it. So it very naturally, just by where it's situated, all the conflicts around it are merely a reflection of its position in the regions it operates. So I think that's sort of the signal generally. However, in spite of that conflict, it's extremely stable. It has an economy which is on a great run. It's setting a standard for a modern economy. And I think I'd want to touch very briefly on AI and power in that context. I think, look, diverging, the opportunity with AI is to accelerate our human capital on almost every front. And I think AI should do for Africa what mobile technology did for Africa several years ago, give us an opportunity to accelerate and leapfrog our capacity. And the fact that where Egypt is situated in its confluence in the world presents a unique opportunity on many of the key things we need to accelerate that, top of which is energy and an energy transition, infrastructure, and then a pathway into the continent. So you have this remarkable opportunity, a good sized market, good human capital, an opportunity to accelerate that, an opportunity to be a major manufacturing hub into the continent, and an opportunity to be a major energy hub into the continent. So there's lots of really good things going for Egypt. You know, I've been applying for my Egyptian citizenship for a while, so I might as well make the pitch now. But I think Egypt right now is a shining light on the continent, and I think what we really need to see more from Egypt is its ability to galvanize and convene the rest of the continent with some of the models and opportunities which the continent has.
Yeah, thank you. I have to end with the Mr. Minister, so we kept you for last. And you seem to be very calm and happy. Definitely you closed, you're smiling. And
by the way, I'm happy because I'm with you guys today. So don't take it beyond that, but in general, I'm always confident in this economy, in the people, in the private sector here. And that's a big, one of the reasons why I'm very confident about what we can do together.
That's lovely to hear. I mean, looking at the situation and how our borders we are in the crossfire. I mean, but if there is something, at least myself, to be proud of, that our government and its institutions has been able to mediate the ceasefire in Gaza. And I think this is something, this was a disastrous humanitarian crisis. And I'm very proud that we have been part of that. But with problems in Gaza, with problems in Sudan, with the limbo in Libya, reconstruction is coming. So let's look at it from a positive point of view. As a Minister of Finance, how do you envision the role of the private sector, Egyptian private sector companies playing, construction companies, healthcare companies, infrastructure companies, and what would the ministry do to incentivize this? And at what extent this could be a game changer to the Egyptian economy over the coming few years?
Thank you for that. And in general, one thing that Egypt has been doing quite well over the last years in general is that it has built a lot of resilience in dealing with shocks. And also, we have now established, through the private sector, very large companies that can do a lot of big infrastructure projects. They have been doing it here. They have learned a lot there. They have gained a lot of experience. And now they are doing it in Africa, by the way. We shouldn't be losing this. There are 4 or 5 or 6 big private sector companies that are doing big things in Africa, a couple of $1 billion of projects. I'm not talking about small projects. And so they now have the experience, the logistics abilities, the ability to be connected also with supply chains, the ability to be competitive in the bidding, the ability. We need to back that, and one of the backing is also our expert support program that is also building some buffers there. One of the things that we did in this program intentionally is that we kept a reserve for the Minister of Investment and the board. I think a lot of the board members are here also, including myself as a board member there, to be agile during the year. If there are an opportunity, we can come up with something creative, with something tailored. So I think there is huge opportunity, but also keep in mind that also there is, as Karim said, there is a lot of also interest from big companies to be now operating in Egypt and in partnership with the private sector. We're seeing a lot of Turkish companies. They are also very active in some of the reconstruction globally in general and regionally. So I think there is also great complementarity that can happen. We have a very good base. We have the proximity, of course. We have the knowledge. We have the private sector capabilities. So I think I'm optimistic in general. But more importantly, I'm optimistic for the people themselves, for the people in our neighbor countries. They deserve a much better opportunity and a much better life. And it's not about we are gaining from that. It's about they gain from stability and from a better, I would say, better life and better services, and also for opportunities for them for job creation. So let's all be optimistic for them, and I think they deserve a much better prospect.
Thank you. Thank you so much. Thank you for the attendees for being such attentive, and thank you for the esteemed panel for such a great panel. Dr. Abla.
Yes. Now we go for the vote. But before the vote, I have to say that Ehi has been working very hard at applying for citizenship in Egypt, and I'm trying to help him do this and get married and settle down in Egypt. Now you have, okay, or your business is guaranteed and you're okay.
Yeah, you have lots of friends.
Now we're gonna do the vote. We have a question at the end of every session, and we do a vote. This is for you, all right? For the Gen Zs and for the others, on how to answer the question on the basis of what they heard and what they know about these things. So let's have the vote, please.
We cannot vote? We cannot vote. Huh?
You can vote. You can vote, actually. I think you should vote. Huh? We actually should vote. عايزين نديهم الورقة يبقى يفوت. You're going to influence the vote. Yeah. The question is going to be.
Take yours. Okay.
Let's see the question. Yes, in your view, is the continued war between the United States and China an opportunity or a threat for emerging markets? An opportunity for repositioning, and B, a threat and source of volatility? We have 59 seconds.
Hopeful, yes. They're trying to get into the gold buying business in Egypt.
Now this is very interesting, really. The results are very interesting. All the young people see an opportunity for repositioning, when the older people see it as a threat and source of volatility. Okay, this implies a lot about the personalities, about what they've seen in the past, to what extent they trust anybody. So
بيقول اللي اتلسع بالزبادي.
ايوه بالظبط، اللي اتلسع بالزبادي ينفخ في، لا اللي اتلسع من الشوربه.
أنا بس حبيت أخدعك.
ايوه اتلسع من الشوربه ينفخ في الزبادي. Thank you very much. Thank you, Omar. Thank you, Ahmed, and thank you all of you. Please, let's have the picture. And please remain seated. This is going to be the last plenary session. And then after that, you're going to have lunch. Please remain settled down unless you're dying to go to the toilet. Otherwise, just stay down. There's nothing outside.